you're hot.
Oh. Good evening. Good evening, everyone. Hi, good evening, everyone. My name is Neel Kashkari, President of the Federal Reserve Bank of Minneapolis. And on behalf of the Minneapolis Fed, thank you all for being here and welcome to join us for this great event that we have over the next few days. Our colleagues at the Minneapolis Fed approached me 6 months ago or so, maybe 9 months ago, and said, we're coming up on the 50th anniversary of this wonderful partnership between the Minneapolis Fed and the University of Minnesota, the economists at the University of Minnesota. And they said, we'd really like to celebrate it. Would that be okay with you? And I said, yeah, I think that'd be pretty great to celebrate the 50-year partnership and how much the country has benefited in the economics profession and the policy community. So we're really all excited to be here. And I think the fact that all of us are spending the next few days together to honor this historic partnership, I think it's really well deserved. And I hope that 50 years from now, there will be another event similarly in scale, maybe even bigger, to celebrate the ongoing partnership that we have over the next 50 years. And so I'm excited to kick off tonight. We have a few days of events here at the Minneapolis Fed, tomorrow at the U, then back at the Minneapolis Fed. And I think that that's appropriate that we're going back and forth because it really has been a strong collaboration from both institutions. Now, I'm going to moderate the first panel tonight, which is a topic near and dear to my heart, which is how is economic research influence policymaking? I'm always challenging our economists, both in the bank and our consultants from the U, on helping me bring practical application to their ideas. Sometimes they're excited about these questions, sometimes they're less excited about these questions, but that's okay. But that's the topic for tonight, and so I'm thrilled at the panel that we have. Now, I'm going to introduce the panel very briefly. They're each going to take about 15 minutes to talk about their research and their perspective on how research influences policy. I may interject and ask them some questions along the way, and then at the end, if we've got some time, we're going to turn it over to all of you. So I'm going to look to all of you to really ask the tough questions, the questions they don't want you to ask. So that will really make it fun for everybody. So in alphabetical order, welcome to Lars Hansen, the David Rockefeller Distinguished Service Professor from the University of Chicago. Then we've got Finn Kydland, the Jeffrey Henley Professor of Economics from UC Santa Barbara. Nancy Stokey, the Frederick Henry Prince Distinguished Service Professor from the University of Chicago. And Rob Townsend, the Elizabeth and James Killian Professor of Economics at MIT. So I think we're going to go in alphabetical order. So if I could ask Lars if you want to join me here at the podium, and I'll hand the clicker over to you. Please welcome Lars.
Thank you. Thank you. This is a nice opportunity to be here. We're supposed. I think I flunked my assignment. We're supposed to be talking about how economics has influenced policy, and I'm going to talk about maybe ways in which we want to think about it should be influencing policy. So I'll be deviating a little bit, but I was never good at following rules. So I want to focus on this theme called uncertainty in economics. Why should we care, and what and its interplay, and why I think it's important in policy discussions and the like. So I think let's see, just a minute. So I've been haunted by Hayek's statement for a while now. Hayek wrote this Nobel address. A lot of the Nobel address I would take strong exceptions with. He basically thinks that quantitative economics is largely BS, and that mathematics should be for clarity of languages, primarily. This sentence, though, I think is a really, this paragraph, though, I think is a very interesting one, and an interesting warning that even if true scientists recognize the limits of studying human behavior, as long as the public has expectations of people who pretend or believe they can do more to meet popular demand than is what is really in their power. It seems like this is something that if you want to be economists with doing quantitative policy analysis, we at least have to be cognizant of this. I don't think we should just throw in the towel, but we should recognize there's limits to our knowledge. There's a massive amount of interest recently in kind of machine learning, data sciences, and the like. There's this term that sometimes drives me a little bit crazy called evidence-based policy. Of course, policy should always be evidence-based. So the question is, how far should you go in just letting the data speak? I think of kind of the Minneapolis Fed and University of Minnesota connection is kind of working a little bit against this type of mentality, but as we hit this data-rich environment, it's certainly conversation along these lines. But this is a long discussion, this debate about kind of how far you can go with letting the data speak without engaging in explicit economic modeling, and I think the latter component is critical for understanding the data. So I wrote an essay on this, and then my colleague Stephen Stigler, an expert on the history of statistics and economics, of course, produced something over a century ago that was talking about the same thing from Alfred Marshall. The most reckless and treacherous of all theorists is he who professes to let facts and figures speak for themselves. Keeps in the background the part they play, perhaps unconsciously, even selecting and grouping them. So this is let the data speak thing. I think has big limitations, and that's what we're kind of about models for. There's a fascinating essay that Koopmans wrote on Burns and Mitchell called "Measurement Without Theory," in which he's trying to expose the limitations to how far one can go with kind of the more pure empirical approach. So that opens the door to a term that. I'm kind of intrigued by. At first I was wondering whether I should be insulted by it, but quantitative storytelling. It's like a lot of quantitative economics that we're doing in the macro realm kind of fits under this. We're certainly using mathematical models with numerical inputs to further our understanding and support policy analysis. Ingredients, substantive knowledge, empirical evidence, of course, is one of them. There's a lot of subjective adjustment that goes into it. I mean, clever model building requires judgment. There's no doubt about it. We want to use it to interpret evidence. We want to use it to study counterfactuals for policy analysis. We like models for transparency and clarity and the like. And there's whole discussions of so-called structural models coming out of the econometrics literature that has a history going, I'm sure, much earlier. Jacob Marshak Hurwitz wrote a beautiful paper on what structural models is, and then of course we all I know Bob Lucas's seminal work in this area. So let me push the uncertainty button a little bit further, though. Where does uncertainty emerge? So when I do quantitative storytelling, I think there's typically multiple stories in the background and not just one. And how do we really embrace and confront that in policymaking? So, of course, each model has randomness. It has random shocks, and it requires numerical inputs. And of course, each model is an abstraction. It's a story. It's not intended to be a detailed recording. It's wrong. It's not much of an insight to say that it's wrong, but we somehow think it's insightful. And so how do we use it in kind of meaningful ways? That's a really hard problem, actually, to formalize. But the other one is multiple models give rise to multiple stories with different implications. And how do we integrate that into our thinking? I think good decision makers do this informally anyway. So, and of course, there's the statistics has wrestled with this for a long time. But how do we build frameworks and apply them to confront policy uncertainty, broadly conceived, to capture the notions that are models or simplifications, to capture the fact there's maybe multiple stories on the table? I think these are important challenges. So why might we care? So let me just put some policy issues on the table here. Uncertainty and financial market oversight. So after the financial market, after the financial crisis, we got new boards showing up in the U.S. We got the Financial Stability Oversight Council created in 2010. Europe, the Financial Stability Committee. UK, Financial Policy Committee. We talk about macroprudential policy now. We start discussing capital requirements, how they should vary with the business cycle and the like. There's been a huge literature on so-called systemic risk that has emerged since the financial crisis. But really what this is so far is not just one, but a whole grab bag of different stories, rationalizing interventions in financial markets. How do we sift through those? I think remains an interesting and important question as we frame financial policies. These different models have different implications, and I think we're barely scratched the surface in terms of trying to sort through them. I actually think it's better to think of this as not risk, but uncertainty, broadly conceived, and better view this as systemic uncertainty. There's limits to our understanding of systemic risk challenges. So for policy making, it seems like that has to be taken that should be taken into account. When I was first thinking about these issues, someone brought up to me a Potter Stewart quote about pornography, that he wasn't going to define it, but he knew it when he saw it. And somehow you want the systemic risk or uncertainty thing to go beyond just that we know it when we see it, but it's something that we can make operational. But I think there's interesting challenges going forward, and I do think this is a case where at the moment we're talking about multiple stories. There's network externalities. There's externalities coming through constraints binding that depend on market prices. There's a variety of different notions of kind of how this can operate. So how do we confront that? So here's another topic that's uncertainty, climate change, and economic valuation, something I've been working myself in for a while now. And here's, of course, there's a conceptual difference potentially between social valuation and market valuation, because the argument is this is a case where market valuation may fail to account for the full social impact of human impacts on the climate, the so-called externality. This is a case where tools like asset pricing, even though it was invented to understand financial markets, can help think about uncertainty in the context of social policy. There's a whole variety of interesting and fascinating contributions to decision theory under uncertainty that have emerged in the last couple of decades from control theory, from economics, from statistics. And if you do calculations like this, it turns out that uncertainty can have a big impact on the measurement of social cost of carbon. Do we have a number to send to the EPA now? Nowhere close to it. There's a whole, the numbers in the literature are kind of all over the map depending upon what type of assumptions we make. And the social cost of carbon is this idealized target that we could define formally as this Pigouvian tax, but there's hardly some consensus on what that number should be. And how does uncertainty play a role into this? Why is uncertainty important here? There's two pieces that come into play here. One is there's the impact of CO2 emissions on temperature changes that plays out over multiple periods, coming from climate science. And then when the environment itself changes, that changes economic opportunities and well-being, so-called damages. It's kind of pie in the sky, I think, that we kind of nailed both of those issues at this juncture. So let me just pull out a graph. This is a kind of something taken from the climate science literature. And this is so-called climate sensitivity parameter. Now, climate models are very, very complex. They're highly nonlinear. There's a whole bunch of models out there. There's a rather substantial number. And what this histogram does is it takes the output of those models off of different type of scenarios and quantifies how much temperature responds over, say, multiple decades to say, changes in emissions. And that's called the climate sensitivity parameter. And then you just document this across models. That histogram showing you the differences across these different models. We're projecting into the future here, and so this is going to be very heavily model-based almost by construction. But this is just showing you that from climate science, a range of predictions coming out of this about how sensitive the climate is to these changes in emissions. And so this is hardly something which we know, and said this is hardly something which we can pretend to know. Now, economists have been talking about economic damages, and let me just put out a plot here. You can think about, I've got specifically a range here over which there's lots of agreement, and that's a range over what we're currently in. And the disagreement's all over what's going to happen in the future over levels of temperature changes which we have not yet explored or experienced. So this low damage one, you can roughly think of that as a Nordhaus type scenario, in which he's kind of gone and interviewed a bunch of so-called experts, although a bunch of climate scientists would claim they weren't included in this, and has a relatively low damage type trajectory. There's more like the Weitzman type notion, under which is a much higher notion of the damages off here in the tails, which we haven't experienced. So how do we confront that type of uncertainty? How do we weight between the low damage, the high damage? We just go all in on one or the other, or do we acknowledge the fact there's uncertainty there? And this is going to matter when you're doing things like the social cost of carbon calculations. Now, climate scientists would like, some would like us to go one step further and just impose a so-called carbon budget constraint. I just stuck it here at 2 and say, which have policy design, so we only allow temperature to change up to 2 degrees, because after that, the Earth is kind of totally destroyed. And so they would prefer us to even go further on this type of calculations. But the point I want to put on the table here is there's these multiple portions of uncertainty, and they interact. And they can magnify each other, and they can have important interactions. And quantifying this type of uncertainty seems to me to be a first-order concern if you want to think about designing policy in this area. So I think for a variety of policy problems, putting uncertainty in the forefront and not leaving in the background can be very important and very prominent, and should be much more emphasized in policy discussions. So I think my time is almost up. I'm not sure the U.S. has a whole lot. I'm not sure America has a whole lot of great philosophers. So I'm going to pick my favorite, Mark Twain. Education is a path from cocky ignorance to miserable uncertainty. So uncertainty can potentially be miserable, but there's also ways we can confront it and cope with it and use it in more prudent discussions of policy, in my view. Thank you.
So before you sit down,
yes,
I have a question for you. I'm going to take the liberty of getting to be the moderator. I was trying to decide if quantitative storytelling was a better way to describe monetary policy, or cocky ignorance to miserable uncertainty. You take your pick. But in terms of uncertainty, I'm just curious your reaction to a current debate that we have in monetary policy, which is some people look at asset valuations today, and they say these are investors reaching for yield because the Federal Reserve is keeping rates low. Another story is that markets are repricing in a lower R-star. Mm-hmm. Those are 2 very different stories, very different policy implications. How do you think about reconciling those 2 different stories?
So I'm not sure we should necessarily reconcile them because we may not have the evidence to sort them out. But when you're designing prudent policy, you want to make sure that it somehow makes sense under the multiple type of stories which you want to entertain. And so instead of like going all in on one story or the other one, you want to start thinking about things that are in some sense more robust and work well over the different possible stories. I do think, I could say more about this in the sense of I think that the Fed should not be spending so much time looking at the details of financial markets. That should be left to other stuff. And I think we spend far too much time thinking about monetary policy narrowly conceived as opposed to financial market oversight and regulation and fiscal challenges. But that's for a different conversation.
Wait, but hold on, I want to make sure I just understand. First you said the Fed shouldn't spend so much time focusing on financial markets, and then you said we shouldn't spend so much time on monetary policy, we should focus on financial markets.
No. We're designing interest rate policy, trying to use that as trying to focus on it's the scope of that to try to make sure that we have financial stability. I think is not a great idea. Yeah. On the other hand, of course, the Fed needs to be like lenders of last resort and certainly have activities like that as well. Somebody has to do the oversight of financial markets, and so the Fed plays roles in that right now too. But I want to distinguish that from the setting of kind of interest rate targets and the like.
Right. Thank you.
Yep.
Thank you. So, Finn, could I ask you to come up, please? I don't know if you have slides.
So thank you very much for inviting me to this important event. 50 years. So,
You have to put on the mic.
oh,
There's a little switch.
I'm generally regarded as technologically challenged. Here's my mobile phone, flip phone. So, 50 years. I actually go back 43 years, so maybe I'm among the longest of those of us here. After my PhD at Carnegie Mellon, I went back to Norway for 3 years. Fortunately, in the middle of those 3 years, I talked Ed Prescott into coming to Bergen. So I came. So when the business school in Bergen gave me a year off, it was obvious to me that this was the place I wanted to come. Now I was a visiting scholar. I had an office in the department. During that year, at some point, Chris Sims comes up to me and says, "Well, I bought off the third in the sequence of the first-year macro courses. Would I be willing to teach it?" And then Jim Simler, the chairman, came up with a compensation proposal, and I agreed. Now, in that course, I had some pretty good students. Just to name three: Rawa Yagari, Svi Eckstein, Marty Eichenbaum. And of course, Marty was one of the at Carnegie Mellon. After I went back there, we hired him. That was his first job, back when Ken Singleton was there also. And I remember at times going up to Marty and saying, in fun of course, "Marty, you forgot everything I taught you in my course." Anyway, by the way, I noticed in the suggestions for things to talk about, stories were welcome. So that was the first time here. The second was in 1988, the full calendar year. I visited the Fed, and that was a year when Dave Backus, Patrick Keogh, and I worked on international business cycles. And so during that year, we produced what has come to be known somewhere, especially in Europe, as the BKK model. I've noticed that evidently it's so well known that if you say the BKK model, everyone knows, especially in Europe, what you're talking about. So, and that's when Dave and Patrick started referring to my office as the lab. And so at the end of that year, they decided to take, Dave, Patrick, Tim, Victor Rios, Dave Backus, and Ed Prescott to take me out to a great restaurant downtown, Osteria Fiorentina. And during that, but after one beer, Tim whips out 6 lab coats. So we all put on lab coats in the middle of the restaurant. Guests come up to us and say, "Who are you? Are you doctors?" No, we say, "No, we are scientists." I was, because I was the first, I guess, only reason I can think of, I was elected chief scientist, and Tim, the grand poobah, in part because he has the ability to perform the duties of the person of the same name in the Loyal Order of Water Buffaloes in the Flintstones. So that was the first year I was back, and then I went back to Pittsburgh for half a year and came back here. And that time I was invited by Chris Sims. He had recently started an institute called Institute of Empirical Macroeconomics. During that year, Ed and I wrote our paper on real facts and monetary myth, which has been well cited, and it appeared in the Quarterly Review. And we also worked on our two-margin business cycle paper. I would like to show a couple of pictures. Let's see. Okay, so kind of to get the setting for how the post-war period has evolved. Here's a picture of the of real GDP per capita, starting in '47 and up until basically now. Now, the straight line represents the average growth from '47 through 2007 and extended to the present. And as you can see, it works pretty well. Usual ups and downs. Usually at the bottom of a business cycle, we recovered fairly quickly. The exception is the very last one. And so if we look more closely, oh, and by the way, if you look closely at that picture, the first half of it, growth was a little higher than towards the second half, but not that noticeably. So this is a blow-up of the last 20 or so years. So as you can see, in 2008, we dropped well below this trend line on the order of 11 or 12%, a big drop. But what's more amazing is that since then, rather than recovering quickly back towards the old trend line, we've been moving further and further away from that old trend line. So I have a paper with Carlos Sarasaga at the Dallas Fed in which we tried to account for what happened during this period, and it had to do with the expectation that taxes would rise in the future because debt had been accumulated heavily during the Great Recession, and there was a report from the Congressional Budget Office indicating how much more revenue the government would need in order to keep the debt to GDP ratio from rising further and further. So that's what we calibrated the model to, and it basically accounted for about 80% of the drop in investment, about 40 or 50% for the drop in labor input. And one thing we liked was, so I remember a half-page story in the Wall Street Journal about why consumption held up as well as it did, and in our model that fits well. Now, one reasonable question to ask is that extension of the straight line reasonable? And it turns out it's not. And Carlos and I had already did some calculations based on the change in demographics, suggesting from now on it would be shallower. Now here's an interesting picture. And it's interesting how research moves in mysterious ways sometimes. By coincidence, I got, partly because my wife works on, Tanya works on that, I became aware of a rising problem, dementia, including Alzheimer's disease. And for example, a study by Anders Wimo at the Karolinska Institutet in Stockholm suggesting this is going to be a major problem in the future. And so I hooked up with a great PhD student at Carnegie Mellon, Nick Pretnar, and we decided to look into the potential consequences of dementia for the aggregate economy. In the process of doing so, we discovered this astounding thing to us. Maybe it's been known to others. And this, now the red and blue lines are just the smoothed out trends of GDP and GDP percentage changes in GDP and GDP per worker. The black line is, let's say we take the number of people of working age. Demographers used usually 25 to 65 years old. I don't agree with the upper bound, but never mind. The number of them in relation to the number of people over 65. So let's say the working age people to the retired. And this ratio, back in 1950, it was 6.1. Today, it's about 3.2, and it's projected, these are UN projections, by the end of the century to drop to 1.6. So, one could ask, who's going to take care of the old people? Now, bottom line is we find, for example, that if we look ahead to 2100, or 2100, if we compare what the projections would suggest of output, compare that to what it would have been if the demographic structure of today had prevailed all the way till then, the answer is that in the latter case, output would have been, by the end of the century, 39% higher. We can do things like now the effect of Alzheimer's or dementia turned out not to be as high as we would have expected. Suppose we exogenously come up with a cure in 2060, and then this disease is gone from 2060 to 2100. That would raise output by 5.4%, according to our model. Now, if we look into issues such as one issue is that much of this care for Alzheimer's patient is carried on empirically by females, and females. This is obviously a burden on them, and should we build more nursing homes to do more formal care? There's one thing I would like, okay, so if I may do my last picture, because this relates to so what can we do now with these dire predictions? One answer is we could emphasize females more. The women, female portion of the workforce. So this is also, to me, an astounding picture. So this is, and I got the idea from Mark Wynn at the Dallas Fed. who made me aware that in the United States, the labor force participation ratio peaked before 2000, 20 years ago. And since then, it's been declining steadily. A bunch of countries are well above the United States. And a reasonable question to ask is, what could we do to mimic what happens in some countries where this ratio is much higher? The top two countries are Norway and Sweden. And as you can see, they're up around 85 to 90%, a big difference. What is it they do to encourage this great resource to come into the workforce? I was going to point out the top two curves, Norway and Sweden. I mean, one thing you see is that Sweden actually was very high at some point, and then they fell on somewhat hard times in the 90s. In the meantime, in Norway, it was growing, the blue curve. Well, I know the reason for that. When Sweden was doing kind of poorly, many Swedes came to Norway. So back around 2000, early 2000, you would go to restaurants and bars in Oslo, for example. Half the bartenders, half the wait staff, they were speaking Swedish. So I guess the Swedes came and took jobs that Norwegians didn't care as much for. Okay, so I had a couple of more things, but I've run out of time. So
I have a question.
You have a question.
So you talked about the demographics, but your explanation for the change in the growth path after the Great Recession, you talked about debts and deficits as being a big driver of that, if I heard you correctly. What would be the right policy response? One is to change the demographics, get more women working, increase immigration. We could change the ratio of workers to retirees, et cetera. But what about on the fiscal side? Any recommendations on what the U.S. government should do to try to get back on the faster growth trajectory?
I do find it interesting that evidently after the recent tax cut, it's a major tax cut in terms of percent, and there's been surprise that the economy has not done better.
It didn't show up in your chart.
Exactly. Oh, and by the way, one thing I was going to mention is here in this chart, you also see how well the quantitative easing, how
you don't know the counterfactual. It would have been even worse.
You may think so, but
you can't prove otherwise. So we're even. Thank you very much.
Okay.
Thank you.
Thank you.
So, Nancy, could I ask you to come up, please? I'm not sure if you have slides. Okay.
No, I don't have slides, but this is a good one. So it's a great pleasure to be here to celebrate the 50th anniversary of, my mic. Yeah. Here it is. Okay, so it's a great pleasure to be here to celebrate this 50th anniversary of the partnership between the research department here at the bank and the economics department at the University of Minnesota. That partnership's been an enormous success, and I want to start by just talking a little bit about why I think it's been a success and what the ramifications of its success are. So I don't think anybody could have predicted how successful it has been, at the time the project was started. And that success has, I think, been in several dimensions. First, it's just that the economists at both the Fed and the U have made some truly fundamental contributions to economic research. So in monetary policy, in business cycle policy, in business cycle theory, in models, in forecasting, those were tremendous accomplishments that we all know about. Over the years, the two departments have also together produced a tremendous group of graduate students. Lars being a randomly chosen example, who have themselves made significant contributions. Maybe I'm going to say last, but certainly not least, they served as a role model for other Federal Reserve banks around the country. So 50 years ago, most of those other banks had pretty, humdrum research departments. The exception might have been the St. Louis Fed, which had a pretty good forecasting group from even pretty far back. And for many of those, the 50 years, the research department in Minneapolis, was widely viewed, correctly, as the crown jewel of the Federal Reserve System. And it stood alone as a rival to the best academic departments. So now many of the regional banks aspire to and achieve, a much higher standard. So, Chicago, St. Louis, Philly all have good research groups. I think the Minneapolis research department is still the best in the lot. So what's allowed it to be, the leader for so long, so strong and for such a long period of time? So I think one of the reasons is its close connection with the U, which is, as far as I know, much closer than any other of the banks has with, the local university. So, and indeed, and I've spent a lot of time here, sometimes it's hard to remember whether a particular individual has their primary appointment at the Fed or at the U. Economists at the Fed teach courses at the U. Certainly all the macro economists at the U have offices at the Fed and spend, a lot of their time here. If you go to seminars, everybody's together. You can't tell who's who unless, you have the scorecard. The graduate students, at least those with any connection at all to macro, and maybe it's all of them, they spend all of their non-class hours at the bank. Sometimes I think they spend all of their waking hours at the bank. You hope they have a home to go to once in a while and, shower, change their clothes. So this close connection has been part of, I think, of what's allowed both departments to, hire and retain researchers of the very highest caliber. So I applaud those achievements as someone who loves my field and as someone who's personally benefited greatly in terms of my own research from, numerous visits to the bank. But why should the bank here care? Why should the Federal Reserve System care? Why should they support not just one research department, but 13, 12 regional banks and the Board of Governors? I think it's a good idea, and the main reason is that, as economists, we agree on many issues and can offer lots of useful advice about policy issues that the Fed faces. It's useful to have top-notch economists on hand to offer professional insights into the question of the day. Okay, so that's great, but still, why 13? Well, economic science is not a finished project. So while we agree about many issues and the answers to many questions, there's still lots of issues where there are kind of multiple models, multiple ways of interpreting data, and multiple views about policy. So I think it's healthy to have a number of research departments with somewhat different perspectives and biases. And the reason is a strong research department gives the president of a Federal Reserve Bank access to the best new ideas and the best new empirical research in the whole profession. The members of the research department go to the best conferences, hear the best people in a variety of areas, present their new work, as well as presenting their own work. And that work gets, discussed and criticized and debated at those conferences. It's important to have those connections in a number of different areas. So obviously, monetary economics and macroeconomics more broadly are central. And because of the Fed's dual mandate, labor market stuff is central. But other areas are important too, because they impinge, anything that impinges on the economy is, sometimes at least very important for Fed policy. So fiscal policy on both the tax and the spending side, financial markets, what's happening in the banking sector, international trade, tariffs, for example, international finance, exchange rates and sovereign debt, housing markets, you can go on and on. The research department here acts as Neel's, eyes and ears, staying abreast of the best new ideas in the whole economics profession. And the members of the research department, they, hear those ideas, they can absorb them, filter them, and try to adapt and apply them to current policy questions. And, we want Neel and his colleagues to be well informed because, as citizens, when the Open Market Committee meets in Washington, they're, discussing, they meet for 2 days. I guess quite a lot gets said. The minutes don't cover everything. And so, we want those discussions, to be as well informed as possible because we're all going to live with the consequences of the monetary policy. And monetary policy is probably unique because it is made at such high frequency. So the Open Market Committee meets every 6 weeks. Why? I suppose it's because, news about events that are important for economic decisions arrive all the time, and financial markets especially react so quickly to news. Like now it's measured in seconds or minutes, so it's, 6 weeks is not, too fast to be thinking about policy. So you can't I think that's probably the reason monetary policy can't be made on an annual or biannual basis, the way, say, fiscal policy is. Spending decisions or tax programs are in place even longer. So monetary policy needs to assess and respond to new data very fast. And keeping abreast of current research, I guess, especially current empirical research, is valuable in formulating good policy. Okay, but interpreting data quickly is far from easy. So, I have here, anyone who seriously believes that let data speak for itself is a useful way to look at data has never looked at economic data. So Lars has already talked about this point. It's just, the quantity of data is overwhelming. And most importantly, you have to know what question to ask and how to put the question to the data. And then how to interpret the answer you're getting and how to decide how robust that answer is. Does the answer change if you phrase the question a little bit differently or look at the data from a little bit different angle? Okay, so to close, I want to mention 2 issues that currently are much debated: the independence of the Fed and the somewhat related issue of whether the Open Market Committee could be replaced with a policy rule. So, I think, like most economists, independence of the Fed is a terrific idea, and it's worked very well. The great moderation, I think, was in large part due to excellent Fed policy over an extended period. an excellent policy doesn't mean politically expedient. So I think Ronald Reagan gets, a lot of credit. He signed off on the recession engineered by Paul Volcker that ended the inflation of the 1970s and set the stage for the Great Moderation. More recently, Ben Bernanke and Janet Yellen, pursued a seamless policy after the financial crisis. Bernanke's a Republican and Yellen's a Democrat, but they're basically both professionals and in large agreement about the policy that was needed. Okay, so if there's so much agreement, can't good policy be implemented with a rule, one that would make the Open Market Committee obsolete? And maybe the best example is the answer to that is to think about events after the collapse of Lehman Brothers. So financial markets, were in free fall. Non-financial firms were in a panic. And the whole country was more or less terrified at the prospect of a second Great Depression. So the Fed, both Bernanke as chair and Geithner as president of the New York Fed, with the support of the Board of Governors and the presidents of the regional banks, took extraordinary measures, truly extraordinary, and I think may have indeed averted another round of the 1930s. I mean, we'll never know for sure, but I think as bad as the Great Recession was, it could have been even worse. And the country was lucky that at that time, Fed policy was well informed by professionals, and I'm thinking especially of Bernanke, who had read and absorbed the lessons of Friedman and Schwartz's monetary history of the United States. He knew very well how the Fed in the 1930s had contributed to making the Great Depression worse by letting the money supply collapse, and in Friedman's view, that was a big part of the problem. So so we were lucky to have Bernanke, who knew that lesson and knew how to take that lesson and adapt it to the 21st century, where financial markets were quite different. The flight to safety took a different form. And, the Fed decided to take a different route the second time. No need to make that same mistake again. At least if we're going to make a mistake, let's make a different one. So I don't think there's any doubt that economic research is critical for good policy, and I don't think there's any doubt that, and I don't think there's any rule that could be written in advance that could have done as well as the current system, which allowed plenty of discretion, did for us. So economic research is critical for good policy, and I think strong research departments at the regional banks give all the bank presidents access to that research. And I'll conclude by applauding the Minneapolis Fed for leading the way in bringing the highest quality of economic research to bear on monetary policy, and the individuals who conceived the idea of this partnership and nurtured it over the last 50 years. I guess we'll see and hear from many of those individuals over the next 2 days. And I'll stop there.
So, Nancy, I have a question for you. You gave us a lot to think about, and basically, I'm glad you said don't abolish the Federal Open Market Committee. You touched on very briefly, you mentioned the labor market. And as you know, here at the Minneapolis Fed, we launched a new research institute focusing on economic disparities and economic opportunity. Some people have said, hey, Fed, you're straying outside of your mandate. You're going to jeopardize your political independence. I'm just curious your take on research like that. Is it important? Should Federal Reserve banks be looking at those type of topics?
I think it is very important because labor markets have changed enormously. And I'll say the other thing that's changed enormously is, we have so much better data now on what goes on in labor markets. We have micro data that, even 20 years ago wasn't available. But we can see how the structure of jobs are changing. We can see in a lot of detail how individual careers are going over time. We can see in detail, you know, what happens over their lifetime to individuals who are unlucky enough to be, you know, entering the labor market when a major recession hits. You know, it just, you know, if we think about this dual mandate, you can't just take, you know, the unemployment rate, because that's an average of rates for prime age males, married females, new entrants, you know, and so you have to think about like what's going into that headline number. So I think it's absolutely part of the Fed's job to think about labor. And you can't just say, well, we think about this part of labor markets, but not that part. So I think it's perfect. I think it's, you have to do it, yes.
Thank you. Thank you. Rob? This one here. You just go forward.
Okay, thank you for inviting me to participate in the panel. Of course, I'm remembering that I was a student here and spent a lot of time at the bank, so my career began here at the U and the Minneapolis Fed. I wanted to address the theme, how economic research informs policy, and I have a little bit of an outline. I'm going to focus, I could have chosen, I suppose, many things, but I'm going to focus on risk sharing and how theory and then data have implications for policy. There's a corollary to that part of the talk, namely a great value to surveys, including those conducted with central banks and governments, and these surveys have had impact. Then I'll turn to an example of cross-country policy guidance that has come from this theory-data nexus. And finally, I'll focus my final remarks on parallels of the earlier work with work going on in the US. So we have this abstract idea, Arrow-Debreu theory, and the optimal allocation of risk-bearing. It was, you would say, a pure conceptualization with the result that idiosyncratic or household small enterprise specific shocks should be in an optimum fully shared and dissipated so that they have no influence, whereas aggregate shocks cannot be dissipated, but the theory of optimal allocation tells us who should bear them. In early days, this theory had not been tested. I must say that I've edited these slides. I have a companion set with a lot of references, but it obviously consumes a lot of space on the slides. I jumped in looking at Village India and had a shocking conclusion, namely that these poor communities were doing remarkably well in reaching something close to the standard of an optimal allocation of risk-bearing in smoothing against idiosyncratic risk. This I call a shocker because people did not expect that to be a result going into it. And it certainly went against the presumption of policymakers who felt, with all good intentions, that they would have to intervene at the individual and village level in order to deal with the problems. Whereas, to say it in different words, the community as a whole was doing quite well on its own. So that created a bit of a firestorm that probably helped bring some attention to the work, actually. Well, it raised another issue. Were these villages in India exceptional? So I trotted off to Thailand. Bob may not remember this. I remember at Chicago telling him I was off to search for Arrow-Debreu economies. And Bob says something like, well, good luck with that. So I started in villages in the north and eventually got funding from the National Institute of Health here in the US to fund large-scale Thai surveys. And I want to tell you a little bit about what we found in the data. First of all, informal networks. They help the formal sector behind the scenes. If we didn't have the data, we would not know. And they help with policy interventions. So I have several examples of this. On a day-to-day basis, there's a very lively village network in Thailand. It's really much akin to sophisticated US money markets. Bridge loans help repay formal loans, the bridge coming from the informal sector. There are credit chains that link more than two parties together. Obviously, default at the end of the chain can make its way back to the beginning, but also early prepayment of loans likewise comes back across the chain. And this device, bridge loans in short, again, achieves something close to full risk sharing. Another example, the government in Thailand implemented a village-level savings and loan and funded it at 1 million baht, regardless of the number of people in the village. We exploit that to get quasi-exogenous per capita treatment. And I've discovered this more recently. Kinship networks kicked in at the time. Not only did the informal sector help in the implementation and impact of the quasi-formal village fund, but also actually was enhanced. And what I mean by that is there's a switch to characterize it, borrowing and lending as a financial information regime to something more sophisticated, actually, costly state verification, especially for low wealth households, meaning that financing of investment and risk sharing came with costly audits if a household were claiming to have low income. And in the data, these costs of verification are lower for kin relative to non-kin, especially after the village fund comes in. So the village fund, which was a large program, seems to have activated and draw on these village networks. Now, things aren't perfect, obviously. When it comes to the financial costs of health shocks, there's something in Thailand parallel to Amy Finkelstein's work in the US for Medicaid. In Thailand, those financial expenditures not covered by Thai formal insurance are covered by gift giving, especially when someone has kin in the village. But if you're out of luck on that dimension, then your shocks are uncovered. And furthermore, those shocks wash downstream to people that had been hired in the family business of the household that got sick, and also the purchasing of inputs into that business. So those other households suffer. So then we get into this issue of, okay, so things aren't perfect. If and how can we fix it? And so that has to do with designing new elements to financial systems that are not currently there. So let me give you some examples, which are, I think, implementable. Risk and return, not just in consumption, but in production in these Thai village economies. The idiosyncratic risk component is huge. It's much, much higher than the village aggregate risk component. But if you look at the rates of returns on funded projects and businesses, in terms of the risk premium to compensate for the residual risk which is held, the story is the opposite. Namely, the risk premium is large for the macro risk and not for the idiosyncratic risk. So again, that's symptomatic of the fact that these villages come close to covering the idiosyncratic risk, although there is a small residual risk premium for the idiosyncratic risk. And these gifts and loans I've been referring to are evident in the data as the underlying mechanism that's allowing the smoothing to go on. Now, the aggregate shocks aren't covered, and I said earlier, of course, they can't be covered. Well, at the village level, no, there are aggregate macro shocks for the village, but those shocks vary across villages and in some sense become idiosyncratic shocks for the region and certainly for the country as a whole. So one could imagine building better infrastructure to link these villages together, and I'm engaged in that with fintechs in collaboration with the Central Bank of Thailand, writing up, creating platforms and smart contracts on distributed ledgers and so on. Now there is a caveat to this, imposing something new on a village, which is you can hurt some people who are there. Covering the aggregate shocks better means that the more risk-tolerant people who have been receiving, supplying implicit insurance to their village neighbors and collecting an implicit premium for it would be hurt by this intervention. Now, there's a corollary to what I've been talking about, but let me make it explicit. My data, so-called Townsend Thai project, was funded in the last 3 years by the Central Bank of Thailand and by the Thai government. It allowed us to get to 20 years of annual and monthly data in urban and rural areas and so on. And the Bank of Thailand is, of course, much aware, not just because they paid for the data, of the results that come from the research. And I would say it's been successful in debunking certain stereotypes. For example, the evil moneylender syndrome, which is, replaced by respect for this lively informal market, or going against the ever-present belief that somehow people in debt should be alleviated of that burden, whereas in fact in the data you can find people who actually need more credit, not less. And this Townsend Thai project prototype has been taken to Mexico and Chile, and it's really part of a larger shift in macro, to echo what Nancy and Neel were talking about at the end, toward micro, not just the concern with micro situations and communities and regions, but also the underpinnings integrated into macro models and then used for policy guidance. So as an example of policy guidance, I'll refer to the apple pie syndrome, which is, we want higher GDP, higher TFP, less inequality, kind of want it all. Well, in a group of us at MIT, me and students, and also they're in collaboration with the IMF, we've created models and calibrated them, populating them with multiple obstacles, not knowing which was really the dominant one. Fixed cost of financial access could potentially be lower, or the spread between borrowing and lending rates could be lowered by better information, or legal changes that reduced or enhanced the objects which could be used as collateral. Now, there's a practicality aspect of this. It's really tough to do this, to do multiple reforms at a time simultaneously in a given country. So we use the calibrated model, provide some lessons. Namely, the impacts are quite different as between wage earners and small enterprise. They're quite different in the short run and the long run. The model provides surprises that have to do, that is to say, things you couldn't see from data alone, to echo a theme we've already covered, because some of these policies are complements with each other, some are substitutes. Some work on an extensive margin of occupation choice, some work on intensive margins. The model makes all that clear. And this was adopted. The model was used in policy advice in Nigeria, India, Honduras, and various low-income countries, and became part of official IMF programs. I was shocked and pleased. It's very hard to think that the theory and models calibrated and so on could have such an impact. It turned out what we discovered was that policymakers were quite ready to hear the message. They kind of suspected this apple pie business was not realistic. They're often in the business of making choices, and they were more than happy to have the guidance and adopted the policy recommendations coming from the models, not least of which is, in the short run, the policy actually make things worse before things get better, and they had to build that into their commitment, as it were, or not take the policy at all. So let me end with some comments on parallel work in the US. I have a quote here from Alan Greenspan referring to community development, which is probably worth reading. Meaningful program review can be achieved only through measurement and critical analysis. Systematic research of community economic programs has been limited. Your challenge, he's speaking into community development departments in feds, is to expand the information base. So the vision here is doing the measurement, and I was reminded of the partnerships that I've been lucky enough to enter into on data gathering at the community level with Federal Reserve banks. We started in Chicago, going into Mexican and then Korean and then African American neighborhoods. That was extended here to the Minneapolis Fed, with teams going into the Hmong neighborhoods and so on. Currently, much more recently, the US is working on data. We have recently these distributional wealth accounts provided by the Federal Reserve Board, and the Bureau of Economic Analysis has been trying to reconcile personal income with GDP measurements, actually for quite a while, but they're missing the concept of integrated financial accounts, linking the balance sheet to the income statement and even to the statement of cash flow. So when I came back from Thailand, having developed financial accounts there, they were kind of taken up in some work that Scott Shue and I were doing at the Boston Fed, and we used that to assess the state of various major US data. So we're not there yet. What we need are regional integrated financial accounts, not necessarily from new surveys, which I understand are costly, but synthetic accounts created from existing data. And there is interest in this, obviously. Mention inequality or voting patterns. Both sides, quote unquote, interested in understanding what's happening locally for their various reasons. And there is the beginnings of some collaboration now with the board and the BEA to think about if and how we could create these regional integrated accounts. So to review, the whole sort of agenda here, discern what the obstacles are, figure out what's there now, figure out whether or not there is this strong informal component on the ground in the US, try to figure out what the binding underlying obstacles are, and build that into the models and make policy recommendations. And I conclude with two ongoing projects, unlike my earlier remarks, which were based on existing papers, many published. We're working on the impact of the China shock, and arguably one could be working on tariffs, not just at the state level, but the point is states are connected with each other, and we can look at trade and financial flows across the states that result from the China shock. And I believe also that monetary policy implementation can be helped by building in a more systematic feedback component from what's going on into the ground into the macro models. Thank you.
So, Rob, I've got one question for you, which is, in some of the countries you talked about their willingness to listen to your expert advice. That seems very different from the environment that we're in here in the U.S. for the last 10 years or so. Any observations on, were you surprised at how willing they were to take your expert advice and back you and look at it compared to what we're experiencing here at home?
Well, I think, first of all, of Nancy's response that there is some receptivity in the U.S. to advice from academics. But to answer your question about Thailand, you know, it's one of these things, is the glass half empty or half full? And there were many times where I was discouraged and frustrated, only to discover that they had been listening. It was a seminar being given, and they started talking about the gap, and they'd had a consulting report from, you know, I shouldn't name names anyway, but a well-known consulting company, and it turned out the gap had to do with the numbers in the consulting report relative to my survey data. So that was kind of like a sign that they were paying attention. I mean, surprised. I guess I'm an optimist in some ways. I go through periods of being skeptical, but I just wake up the next morning and continue trudging along. So
Fair enough.
There is kind of a slant to this talk, which is that theory models with data can matter. So that's the main message I'm trying to get across, rather than the instances where it was less successful, and there are certainly many examples of that.
Sure. Thank you. So how are you on time? So we have time, I think, for a couple questions, and then we're going to have a reception when many folks can ask more questions afterwards. So let me just open it. I had my chance to ask questions. I see a hand in the back. Do we have microphones? Could you just introduce yourself as you ask the question, please?
Hi, I'm Mark Hughes. I'm a Carlson alum, and I just had a thought of when they talked about climate change. Many years ago, I worked at ABC, and when the wind chill charts and everything changed climatically, I wondered how that would change the policy and the economics of our state, because not last year, but in years gone by, if you look at statistics, we've had a little warmer winters than we're used to. So I wondered how that changed the policy and the economics in the state of Minnesota in this matter. Thank you.
Anybody brave enough to try to answer it?
I'm not sure I'm in a position to answer that precise question. I think the real question is, you know, we're trying to figure out from evidence and from models exactly what the nature of this impact is, the human imprint on the environment. And there's lots of evidence that it's there. The quantitative magnitudes, the duration over which it plays out are still, you know, remain quite uncertain. Now, whenever I point this out, I'm immediately, in some quarters, accused of being a climate denier and saying we should therefore do nothing. But it's also the case that decision theory under uncertainty doesn't say you don't do anything. You still want to confront the uncertainty, and and do it in sensible ways. So I don't know enough to give you the precise answer for what's going on in Minnesota with this, but I do think this is a very important challenge going forward, and how to integrate the uncertainty into the answers, I think, is really critical.
So one more question. Anybody? Right up here in the front. The microphone's coming to you.
So Fernando Alvarez, I was a student here and also at the Fed. So this is a question for Rob, but kind of echoing what Lars was saying and also Nancy. So if you could kind of comment about kind of the use of, say, in particular, say, RCTs, which are typically many times viewed as, say, the golden standard, and the idea that then that's why we'll replace kind of our more sort of theory base, and in particular in development, since you have a lot of expertise on that. Say what RCTs are. Oh, sorry.
RCTs are randomized control trials. So you take, a fraction of the population and expose them to a program and not the other, and then make the comparison. And the idea to sort of put it in the positive light is to see not only what works but what doesn't, so you can not continue to develop programs that are not being successful. I mean, I'm quite eclectic in my research, as you know. I could get on a high horse and say, RCTs without theory are not particularly helpful, and I do believe that. I think, Angus Deaton said it quite well, which is, you don't just want to know what works or not works, you want to know why, which inevitably brings in the theory. I mean, I have done RCTs, and in effect this Thai Village Fund thing, quasi, exogenous treatment, we just took advantage of, for whatever reason they did, injecting the same amount of money in communities that varied in population. But then, you go on and use that in the estimation of the model and so on. Am I answering your question?
Well, we're going to continue this because we're going to have a reception now, but I want to first thank the panelists for a very interesting discussion. I think we could have gone a lot longer, but I want to build on something that Nancy said, which is just how important the research is for me and for my job. Before I joined the Minneapolis Fed, I'll be honest, it's hard for an outsider who's not an economist, who's not within the central bank, to know a lot of the differences between the 12 reserve banks. I mean, New York is different because it's in Wall Street, but the other 11, it's kind of hard to tell them apart. It's been a huge advantage for me having the research department that we have here and the quality of the economists and the partnership with the U. And this isn't just happy talk because I'm talking to you and this is the 50th anniversary. This is actually true. If any of you pay attention to what I do in my job, I'm somewhat of an outlier in the Federal Reserve System. So a non-economist basically going to the FOMC saying, hey, all you knuckleheads are wrong. It's pretty obnoxious of me to do that, right? Well, I can only do that because I have a lot of confidence based on the ideas that we debate and test here every day. So by the time I go to FOMC meetings every 6 weeks, the ideas that I'm going to present in those meetings have been beat up and torn apart by our staff economists, by our colleagues at the U, and that's what gives me the confidence to take the positions that I've taken. By the way, so far we've been right. And so I went out to South Dakota and I had a journalist from The Economist embedded with me. She wanted to follow me around for a couple of days to look at my regional trips, and she wanted to report on trade and how it's affecting farmers. Over dinner, she said, you're the only one at the Fed who's taken this view on the labor market. It's been a wild outlier, but so far you've been right. What's going on at the other 11 reserve banks? Isn't the point of the 12 reserve banks that they should all be coming forward with different ideas? How come the other 11 all have the same idea? I said, hey, you're going to have to ask them. But I can just tell you, I've been able to have the confidence to take my views because of the quality of the support that I have here, both with our staff economists and for the U. So everything you said, Nancy, I totally endorse. It's exactly right. And I'm living proof of how important it is in actually working its way into policymaking. So I'm grateful for this partnership and for everything that all of you do to make it as strong as it is. So join me in thanking our panelists. So please join us for the reception and join us tomorrow at the U when this celebration will continue. Thank you.